Welcome everybody to AMR's Client Quarterly Economic and Market Review. We're going to get started in just a moment. As we do, we always have to start with a little bit of compliance for our regulators. Make sure that we remind you that information we have is dated. We're doing this talk on July 18th, and it's intended to be helpful information, but always talk to us if you want to get into the details for your particular situation. And past performance is not necessarily an indication of future returns. Well, thanks for being here. I'm Chris Boyd. Most of you who are our clients will know who I am, and I'm glad to have you with us. Hopefully we'll be able to share some useful information for you as we have been doing each quarter, trying to give you a little overview of what's happening in the markets. I'm joined by Brian Regan as well.
Hi, everybody.
And Brian, of course, is our portfolio manager and economic strategist. Well, and I want to always, remind you that we're a team operation, and there's lots of other members of our team trying to support our efforts in providing you the services that we provide. In our Dedham office, we've got Mike Perna and Lourdes Urbano, as well as the rest of the team here at our Hyannis office. So give us a call at any time if there's something you might need. To start us off, we're going to have a little overview of our agenda here, look a little bit backward at what happened over the quarter. We'll also draw some parallels perhaps to a few years back in the circumstances, what's happening around us now, and what's the landscape for how we see things around us in the world and how that might impact your portfolios. Talk a little bit about valuations, the yield curve, and some tactical considerations. And then we'll try to synthesize all that down for a sense of what we expect to be doing in our portfolios. In fact, what we've already started doing in our portfolios for you this quarter. So Brian, why don't you start off with a little bit of an overview of how things went last quarter and what were some of the key takeaways?
So, we talked a little bit last quarter about the global macro situation, specifically calling out the trade talks and Brexit and how they might impact the market going forward. We made an adjustment where we added some emerging markets to the portfolio in actually February of 2018. As the trade talk rhetoric seemed to be getting a little bit better. And that seemed to have generally worked out for us while we're still underweight. SPEM, which is our emerging markets ETF, has done okay from February, but has underperformed the U.S. stock market. So our underweight has worked out, but we were happy that we had some emerging markets exposure. Domestic stocks we didn't really make many changes to at all last quarter. The S&P 500 we determined to be fairly valued at the end of last quarter, which led us to not really make any significant changes one way or another. The market has continued to move higher, and now we believe it's slightly overvalued today. From a fixed income perspective, we've been underweight credit, which has been a good thing for us. Barclays U.S. Aggregate, which is largely investment grade, longer duration type bonds, outperformed high yield for the quarter. Our intermediate funds, we discontinued the Treasury allocation after we had a nice run in it. The longer term part of the curve met the shorter end part of the curve, and there was no longer a yield advantage there. So we took the gain and moved into the shorter term part of the curve. This was a conservative move, and the longer part of the curve did continue to outperform slightly in the short term part of the curve. However, we did increase our shorter duration investment grade bond portfolio versus the money market fund, and that outperformed the money market fund, so that was a good move, kind of offsetting our intermediate positioning. So when you look at today's market, Chris, we're seeing a lot of the similar data from what we saw in 2015, 2016, where we didn't have a recession, but we did have a slowdown and markets did sell off.
So you think there might be some parallels to be taken as to what might be in the making right now as a result?
It seems like a good way of looking to see what happened back then. The economic data seems similar, and as a expectation of what could happen in the coming quarter.
What are some of those key parallels?
So this first slide here says oilable and durable goods orders. So in 2015, 2016, the oil dropped below $40 a barrel, as that big red line in the chart on the right-hand side shows. This stopped investment in the oil infrastructure that we have come to know in the United States, which dramatically slowed down durable goods orders, which are goods that are expected to last longer than 3 years. Today, we have a similar sell-off in the oil market, not quite as extreme yet. Tensions in the Middle East have brought oil prices up a little bit, but durable goods orders have also been reduced over the last 6 months. We're seeing a slowdown there as well. So it's a similar story from what we see in 2016. Global PMIs, just to review what global PMIs are, it's the Purchasing Managers Index. It's a survey of manufacturing managers throughout the country and throughout the world, and it basically asks them how much they're purchasing from their suppliers. And this is a good just barometer of manufacturing activity throughout the world, and it usually is a leading indicator of what we can expect to happen in the economy. And you can see there in 2015, 2016, we had a drastic fall from highs in the 50s to around 51. Anything over 50 is expansion territory. Now we're really hanging around 50 as of this talk, and the world is actually below 50 in a little bit of a contraction territory. So
something to be concerned about.
Something to be concerned about for sure. It's just another data point that we're watching, and very similar to 2015, 2016. Retail sales growth has fallen off a cliff from the middle of last year. We're still positive. We're still growing, which is a good thing, but a clear slowdown. After the tax cut last year, we were seeing 6+% in retail sales growth, but inventories were also rising as capacity utilization was high. Capacity utilization has started a downtrend to try to work off some of this excess inventory that we have. So what does this mean? This usually is bad for margins. It means it's going to be discounting in the market. And an interesting thing is, despite this trend, Walmart, Target, they're at 3-year highs while their operating margins are at 3-year lows.
So you think that suggests that there could be some concerns when you have that sort of bifurcation of the way things are shaping up?
Yeah, we mentioned that we thought the market was a little bit overvalued right now, and I think this is a good example of that. So there's a lot going on in this slide, but this is our last slide on the 2019-2016 parallels. And this is really what we're talking about is our risk assets here. So stocks and high yield bonds is what we're talking about. And in 2015, 2016, as 20% of the high yield index is made up of energy, we saw a lot of volatility in the high yield spreads, which is the difference between what you get paid on risky debt and government debt. Normally when that line goes higher, that means that the bonds price is going lower, so it's a bad thing. And then we had a nice 10-year bull market in those, and we're starting to see the volatility pick up again, just as we did in 2015, 2016. When we're seeing low growth like we are today, you can expect the S&P 500 to trade in a range, which is what we're seeing in the chart there to the right. From 2015 to 2016, the 12 months from July to May, or that's not quite 12 months, 10 months, we saw the market have 12% drops, but not really go anywhere. So this is also similar to what we've been seeing in the market. If you look back on what happened in December of last year, we had a little bit of volatility in May of this year too. But
so you're suggesting is that this may be something we see again in the near future, where we may see some additional volatility.
Yeah, that's what I'm getting at, Chris. Thanks.
Yeah. Okay. Very good. So let's move on to some of the global macro risk considerations. In this situation, not much has changed since the last time we talked about this in the last quarterly review. There's been some things that happened with China and so forth, but we're kind of about the same place.
Yeah, it's interesting with all the rhetoric. You think something would have happened, but if you step back and look at it, nothing really has changed, right?
Yeah, so we had sort of no talks for a while, and now we're back to talking again. But there's really no movement as of yet. So this remains. What's the trade arrangements with China going to be? How's that going to be resolved? Will it be resolved? To what extent? All open questions that we continue to watch.
Hasn't gotten any worse from last quarter though either.
That's good too. Yeah, good point. Yeah,
which the market seems to celebrate for some reason. I'm not quite sure about that one. But,
that's a good point. What else in terms of Brexit? That remains sort of unresolved on the table.
No longer in the headlines, but still out there, right?
Yeah, it's still a concern to have to pay attention to. Anything else that's relevant?
I think those are the two big ones. Yeah.
Yeah. So we'll just have to keep watching, but that does leave us with some uncertainty. Of course, if the trade talks with China go well, that could really be material in terms of the way the market would respond to that. Do you think?
Yeah, I think definitely. One thing I'd like to add, we have the German flag there.
Yeah.
I think Germany would be affected by both trade talks and Brexit concerns. It's one of the biggest exporters in the world, so any slowdown in trade, it really gets impacted. And Brexit, it's one of the biggest trading partners with the Great Britain, so it'll be interesting to see.
All right, good points. So when it comes to valuations, let's talk a little bit about that. So Brian, you do this exercise routinely where you look at what are the earnings and what that might forecast for where the S&P 500 should be valued at as a price point. You've indicated that over the last few years, the S&P 500 has been trading at approximately a 19 times
trailing
price earnings ratio. Sorry, did I say
otherwise? No, you didn't. I was just getting at it.
And so that's relevant to take that indication to say, okay, where should that help us to indicate where we might expect to be? You want to elaborate on some of the key points of this?
Well, in the top part of the chart there, I'm really trying to make the point that if the market expects a healthy economy, as we've seen since 2016, as we talked about to 2018, trailing PE of 9 makes some logical sense, right? Now,
of 19. Sorry, of 9? What you said, a trailing?
A trailing PE of 19 makes some logical sense. I'm sorry if I said 9.
That's right, yeah.
The middle part of the chart there, I'm trying to show what would happen if we had a change in price earnings ratios from 19. So on the far right, we have the expected earnings per share of 166.44, which is important to point out is $10 lower than we started the year with. And if the market continues to expect good things in the economy going forward, 3,100 plus is not a ridiculous number. It would be on par with what we have seen before. Now, it's important to realize that earnings per share estimate has been coming down throughout the year, and I think it's probably going to be revised lower yet again.
Yeah.
Now, I think if we expect some trouble in 2020, 2021, a PE revaluation down to 17 is not outrageous. That would be around 28, 29. So somewhere between 28, 29 to 31.62 would be fair value in a healthy economy, in my opinion. And that's if there's no change in earnings. Now, the bottom part, we hear that now people are kind of revising to mid to single digits on earnings growth, which doesn't get you to 166. It gets you more like 156, 157. So where does that get you? At a healthy economy, at 5% growth, we're looking at 29.33. At 17, we're looking at 26.24. So where are we today? We're, as of this talk, around 29.90. So it went over 3,000. So I would say that it's a little frothy right now, given the earnings revisions.
All right. So that's an important point to say that your estimate for where valuation is relative to the current price is that the price is a little bit higher than maybe what you expect it to be, and therefore we wouldn't be surprised to see some decline in markets, though not necessarily absolute.
Right, that's right.
So this is more about the notion of the S&P 500. Elaborate what you had in mind here.
Sure. So these charts are a little hard to see, but we have two slides following that blows them up a little bit. But I'm really trying to point out the current valuation on a forward basis and profit margins. So here is looking at the 12 months forward PE ratio versus the long-term average. You see the 25-year average is around 16 and change. Now we're at 17.09. Not outrageously overvalued, but clearly a little bit overvalued. One standard deviation would be 1938. I would consider that pretty significantly overvalued. So something consistent with what we saw in the previous little chart that I made. J.P. Morgan has a similar thought. Now these are profit margins from companies. The red line is large cap, the blue line is mid cap, and the green line is small cap. You can see that due to the tax cuts, the corporate tax cuts in 2018, we saw a nice big jump in margins. And then in 2019, now we've seen it come down a little bit, pretty significantly, and I expect that to flow into earnings and earnings expectations, which is why I think that earnings expectation of 166 is more likely to come down to that 157 mark, and why I think something between 2,800 and 2,950 is closer to fair value than 3,000.
And it's interesting you point out in this chart that this isn't just unique to large company stocks. You're seeing this maybe even more pronounced in some of the smaller companies.
So it's a good chart to illustrate that small cap stocks are significantly more risky than large cap stocks too, where they both maybe come down 50 basis points. It's a much bigger percentage of the profit margin for small cap than it is for large cap.
Okay. Well, let's talk about fixed income a little bit. We know that there's been discussion about the inversion of the yield curve. What should we be thinking about that, and where do you see things moving?
Yeah, so on this chart on the right-hand side here, I have three yield curve lines. The red one's from 6 months ago. The blue line is from about a couple weeks ago when I put together this chart, and the yellow line's from 1 year ago. So if we expect about a 0.5% change in the Fed funds rate, we would be closer to the yellow line, which is where Fed funds was a year ago. You'd see an upward sloping curve, and you would actually see the belly of the curve between 1 and 10 years to be significantly higher than it is today, and the shorter part of the curve to drop lower. Why does this happen? Because inflation expectations rises, and that brings up the belly of the curve. Right now, as the Fed has said over and over again, their concern is inflation, which is why you see the belly of the curve falling. So go out and refinance your houses right now, because my expectation is that the belly of the curve is going to rise, and the short-term part of the curve is going to fall. So that's going to
affect interest rates for not only for investors but also mortgages, as you point there.
Yeah.
So that's going to. Your expectation is that this inverted yield curve becomes somewhat resolved. If
we drop rates quickly enough, and we may even have to go through the whole end of the cycle in order for this to happen. In the short term, it all might come down, but in the medium term, I expect it to be more like that yellow line.
I know we're going to touch on this later, but can you just give a quick indication of how this is relevant as it relates to a portfolio, like what we might be doing as a consequence of this thinking?
Yeah, so we have what we call components in the portfolios, and the intermediate component we would be bringing down, because the belly, they did significantly well as the belly of the curve fell from that red line to that blue line, and we made money, which is why we discontinued the Treasury allocation last quarter, and why we're going to further bring down the intermediate part of the curve this quarter.
And if rates are likely to rise in that part of the curve, that could be disadvantageous for the price.
Right. On the shorter end of the curve, we would increase our allocation to something between the 1 and 2 year, because you could conceivably see that line fall as Fed funds falls. The money market fund, which we've been pretty heavily in, more than probably normal, we will also move out of, because we were getting more and more yield on that as Fed funds rose. We're going to get less as Fed funds falls.
So that'll be impacting our design structure. All right, let's talk a little bit about some tactical considerations when it comes to investments for opportunities.
So this chart's not great, because I'm talking about gold here on the right, and the gold line is the dollar, and the blue line is gold. But it's I think it's a good illustration of what I'm ultimately talking about here. So the idea is that the dollar and gold move inversely to each other. So if you expect the dollar to decrease in value, then gold should conceivably go up in value. There's a pretty strong correlation and some economic reasons for why that happens. So as the Fed funds falls lower versus the rest of the world, and as interest rates in general fall lower versus the rest of the world, we should see a weakening of the dollar, all things equal. So that weakening of the dollar gives us some opportunity to go into gold.
So, just to quickly touch on this, it's important for us to also comment that when it comes to commodities like precious metals do act in a volatile manner, and we want to keep in mind that that's to be expected. As a consequence, we're not likely to overstate our exposure in something like gold. When we add something like that to the portfolio, it's a modest exposure because of the potential volatility concerns.
And to that point, we might not stay on it in it as long as we would a traditional investment. Right?
Good point.
That's okay. A tactical change.
But we think there's opportunity there, and hopefully the timing is good for that. We also do some tactical maneuvering in certain portfolios, ones that have a little more risk profile. The 60-40 strategy that we have that's intended to be a little more tactical, as well as our 85-15 strategies. You want to touch on some of these sector decisions that are happening?
Sure. Well, we were in IYZ, which is a telecommunications ETF, basically because we thought there was opportunity in Cisco and Verizon and AT&T. There's still opportunity in AT&T, but it's only 5% of the index now. Cisco, we had done well on it, so basically it was time to move out, and that's kind of the nature of these tactical things. You don't necessarily stay in them for a sustained period of time. Semiconductors have done significantly well over the last couple of years, and I actually want to stay in this one because I think there's opportunity if the China issue gets resolved, as a lot of the semiconductor companies are out of China. We were in cars because the auto industry seemed undervalued for a time. We moved out of it when the Trump administration had threats of tariffs on Mexico because that would be devastating to the supply chains of automotive companies. So we were staying out ahead of that for risk purposes. Upon review of it this quarter, I think it's best to stay out of it just because GM, Daimler, and Tesla are fully valued. There's not as much opportunity as there once was there, especially after the $50 move in Tesla for the last few weeks. Financials, however, we found to represent a little bit of opportunity. Berkshire Hathaway and Bank of America look like some nice value there. There's also some nice regional banks, and the government let them raise their dividend recently. So all good news there.
Great. And this fits into the notion of another part of our tactical choices. We do a different structure around economic drivers for where to put sector emphasis. Touch on this briefly.
Yeah, so we think we're in the late part of a business cycle here, and the chart on the left is pretty simple to read. I mean, pluses are good and minuses are bad.
Yeah.
When you're in the late part of the cycle, healthcare and utilities tend to outperform over the late cycle and in the recessionary part of the portfolio. So our theme throughout the whole portfolio allocation in this quarter is to stay invested, but more defensively. And this is really smack dab in the heart of that. We're going to stay invested. We're actually going to increase our economic tactical positions here.
And because these economic tactical positions tend to play out over a longer period of time, this is something that is likely to be applied to many of our strategies, not simply those first two we talked about. Okay. Well, let's sum it up for how some of these takeaways are relevant and then how they fit into our portfolios.
Yeah, so I mentioned that our theme is to stay invested, but more defensively. Generally speaking, that means that we're going to lower our overall beta exposure to lower downside capture. So if the market falls, your portfolio is going to fall by less. That's the
Yeah,
idea.
beta exposure. Just basically the concept here. The back end of this is really what's important for our clientele listeners. We're going to try and keep risk a little lower in the way we're structuring the portfolio.
Right.
Okay.
But we still want to be invested because there could be some opportunity.
That's right. That's right.
We want to use gold to generate performance for like the safety trade in a falling dollar. So as people get concerned, they typically like to go into gold. And we talked about how the falling dollar can push prices of gold higher.
And we've seen some moves in gold already. So, even if we are early on such expectation, it could still be beneficial.
From global macro, we're going to stay unchanged from Q2, which means that we're going to be underweight international exposure versus the MSCI index, which is a global index. For strategies with some more risk, we're going to have exposure to India and China, which India has worked out. China, I think, will work out over the longer term. For domestic stocks, domestic stock market has become overpriced as earnings expectations have come down, but S&P 500 levels have hit highs. So we talked about that when we were talking about the S&P 500, and again, stay invested but more defensively. So we're going to decrease the growth allocation, we're going to increase the economic tactical, we're going to increase the low volatility sectors, and we're going to put a little bit more emphasis on value. But we're going to continue to stay invested in the market.
When it comes to fixed income?
We're going to continue to be underweight credit. We talked about how there's some volatility in there now. And when there's volatility, oftentimes there's opportunity. So we're going to keep an eye on that for a chance to take advantage of some high spreads when we get the chance. The intermediate, we talked about how the belly of the curve had fallen. We expect it to rise in the medium term. So we're going to decrease the intermediate part of the curve and increase the shorter part of the curve. If the longer part of the curve continues to fall, we should benefit from increases in gold and utilities. So it should work out well that way.
So that pretty much is a good wrap-up of sort of what's been happening. Brian, you've already been actively making adjustments to our clients' accounts that are under a discretionary strategy with us and implementing some of these themes promptly. So if you have any questions or concerns, we certainly would love to hear from you. We're happy to speak with you. Or any of your family, if you have people in your family or friends that need some help with their financial planning or portfolio management concerns. Do not hesitate to give us a call if you haven't seen us in a while and think it might be a time to come in. With that, I think we'll wrap things up. Do certainly let us know if we can be of any help to you along the way. Thanks for being with us, and we will be planning to do this again next quarter. But in the meantime, we look forward to speaking with you on the phone or in the office.